Hello, I'm Brad Eichler. I head the investment banking group at Stephens, and I want to welcome you to our year-end roundtable where we look back at the major events that impacted 2020 and look forward into 2021 and offer some of our views about what to expect. We're excited to hold this roundtable as we get ready for our Stephens annual investment conference, which will be held November 16th through the 20th in a virtual format this year. I'm very excited about being joined by 8 of my colleagues today and would like to take a minute and introduce everyone before we begin our Q&A process. First, we have Lance Gurley from Dallas, Texas. Lance is part of our Capital Solutions group. Nick Bellman. Nick is from Atlanta and part of our Debt Capital Markets group. Christopher Huizinga. Christopher is in New York and heads our consumer practice. Marshall McKissick from Little Rock, Arkansas, who heads our M&A practice. Bruce Miller from Atlanta, who heads our specialty finance practice. Phyllis Riggins from Dallas, who heads our media practice. Scott Studwell from New York, who heads our equity capital markets business, as well as our depositories institutions team. And finally, Brad Yates, who co-heads the industrials team and was the founder of the firm's specialty distribution and services business. So thank you all for participating and being with us today. 2020 will likely go down as one of the most interesting years in all of our careers. I know it has definitely gone down as that thus far for me. The impact of COVID and the impact that it's had on the world's economy has just been amazing. In addition to the human toll, it's had a pretty profound impact in the way that most businesses, including our own, has had to operate. On top of that, there's been considerable noise in the markets this year with the presidential election that everyone has had to contend with. As with any period of change, dislocation emphasizes the need for sound financial advice. And, we always believe that out of change comes opportunities for those that are poised to capitalize on it. Hopefully our discussion today will address some of these key trends and be helpful and thought-provoking. Okay, so maybe a first starting question, and Scott, I'll lead with you. Early in March, when you think back to that time, which seems so long ago, the markets were reacting fairly violently to the threat of COVID and the implications for the global pandemic. Today, we're seeing the markets react to Pfizer's announcement of a possible vaccine. What surprised you most when you look back at where we were in March, and surprises you most maybe where we are today?
Well, I guess to start the year, the market was effectively a fearless market. When you look at the volatility index to start the year, I mean, we were low teens. I think we were maybe 12 and a half, 13 on the VIX to start the year. By mid-March, when COVID was really on our doorstep, that fear index had ticked up to over 80%, which effectively meant the markets were dislocated, almost uninvestable. And to me, I think I'd say the biggest surprise was how quickly the government stepped in to try to provide, some sense of safety to the marketplace. I mean, first it started with over $2 trillion of stimulus. That clearly was another example of, don't bet against the Fed providing safety. But in addition to the stimulus that kicked in, there were other programs, and obviously we saw the lowering of interest rates. We saw the Fed buying securities in the marketplace, all things to try to, create a better environment for consumers and customers alike. All the tools were being used, and they're being used quickly. So for me, I think the biggest surprise was how quickly the capital markets responded in the aftermath of that. Again, mid-March, we saw a fear index over 80. By the first week of April, we were seeing rescue trades happen in the public markets with the airline industries, the cruise industries, the restaurant industry. So I'd say the velocity of just how quickly the world changed and the capital markets opened up.
Thanks, Scott. What about today? How would you contrast or characterize where we are today?
I'd say we are still wide open. If you think about what we've seen so far in 2020, it almost defies logic. Just as an example, in mid-March, if you would have asked me, would we at Stephens have had a 35% increase in our capital markets activity this year, I would have bet everything against that. So I'd say just the sustainability of that market window opening and how much activity we've actually seen this year.
Let's step back for a second and look at the macro trends. So maybe we could get some commentary out of macro trends we're seeing in mergers and acquisitions. Scott, you hit on capital markets, but maybe a little bit more, and then Lance in capital solutions. So Nick Bellman, do you want to kick us off and talk a little bit about what we're seeing on the debt capital market side?
Yeah, happy to do that, Brad. This goes along the same lines as Scott's comments. It was very shocking to everyone how quickly the markets rebounded. Back in February and March, credit spreads widened significantly. Lenders were not active at all, and if they were active, they were selling out of positions at large discounts. And very quickly after the stimulus came in, the market rebounded. There was a lot of issuance that came back. The risk spreads were still widened, and I'd argue they're still a little bit wide of where they were pre-COVID, but that's largely offset by where Treasury rates are and where LIBOR is. So if you actually look at a all-in risk cost of capital, it's actually lower than it was pre-COVID. And what you're finding is lenders have a lot of capital to put to work. That's both banks and institutions, and they're trying to find a place for it to find yield at those depressed spreads. And so while this movement started at higher quality credits through Q2 and Q3, it's really expanded into get more and more aggressive as we enter the latter half of the year. And that's exhibited by the dividend issuance volume is at its highest level in 2 years as of October. And that's as lenders try to get creative and get more aggressive. And so as we head into the back half of this year and into next year, we expect the lending environment to be there for both M&A, dividend recapitalizations, and elsewhere.
And Nick, from a high level, how would you characterize, general features of debt packages today vis-a-vis where they were maybe 12 months ago?
Yeah, you hit right on it. I think the one place lenders have focused is tightening down on covenants and being able to react if there is another downturn or another shutdown due to COVID. So we have seen tightening there, but from a competition perspective, we've seen the spreads more than offset that. But again, lenders are still cautious. The first lenders that came back to the market were the institutional investors. We've now seen banks come back. And again, they're all keeping an eye on covenants, but every month that goes by, the covenant packages seem to improve as well.
Lance, what about you? What are we seeing in the capital solutions area?
It's certainly been an interesting year, as you might imagine. And I think if you take a step back and we talk about macro trends for the restructuring market, what we've really seen is a continuation of the haves versus have-nots. And just to Nick's point about the activity in the debt capital markets, most of the companies that were strong in a pre-COVID environment were largely able to garner concessions from creditors in 2020, primarily because they had good excuses and that the alternatives were pretty dire for all parties. So what was happening in the restructuring market was a lot of Band-Aid solutions. I've been telling people we've been doing plastic surgery, not orthopedic. And it's been, amendments, forbearances, exchange offers of existing securities to help what were otherwise good companies that just had temporarily been blocked out of the capital markets, continue to operate on a go-forward basis. On the other hand, companies that were either already distressed or as a result of, the economic restrictions are going to clearly have an extended return to normal timeframe. Namely companies in industries like oil and gas or retail or mass entertainment industries. There's significant restructuring activity. So a lot of equitizations through the Chapter 11 process. A fair amount of deals got done outside of court, but we still saw a pretty significant uptick over the summer in Chapter 11 activity for corporate borrowers over $100 million in funded debt. So with a bit of a lull at the back half of the year here, it seems like the market's a little bit more equity focused. We expect that as we flow into 2021, that's going to start to change. And I think we'll talk a little bit more about that today.
Scott, anything you'd like to add on the equity capital market side?
Yeah, look, I tell you, it's been an incredibly active year. Obviously, healthcare and technology, which are always in the middle of the issuance that we see on a year-over-year basis, accounted for about 70% of all IPO issuance this year. I'd say also, one important emerging trend that we saw was really the reemergence of, the special purpose acquisition companies, the SPACs. SPACs alone were more than all other industries combined for total number of IPOs this year. So this was a trend that significantly picked up. And I think, as you'll hear in this presentation, probably has broader implications on the future of M&A, just given the new entrance to the market that these new vehicles have created. And I'd say another trend, which is very obvious to us as we look at the world, we've seen a lot less of the bulge bracket firms using their balance sheets this year to, effectively buy the league table credits and provide financings in the equity world. We've seen a much more traditional underwriting structure universe happen in 2020. Bought deals may be accounted for about 15% of all this year's follow-on activity. That's down from about 40 to 50% over the past couple of years. So I'd say in an uncertain environment, issuers are really capturing the value of using partners to turn over every stone to achieve successful outcomes.
Marshall, what are the macro trends we're seeing within the M&A markets?
Brad, I would say that the M&A market is well on its way, back to some sense of normalcy. In the third quarter, we had $1 trillion M&A market in Q3, which was up substantially from the decline in the second quarter and the COVID-related impact to the M&A markets. I would say, going into the Q3 and Q4, tremendous amount of pent-up demand for transactions, just from the dearth of deal activity in the second quarter. Of course, we've seen a rush, to get transactions done in the fourth quarter. Potential tax increase, regulatory administrative changes. People, thinking about that headed into 2021. The credit markets, as Nick had said, very supportive. They've bounced back. Very supportive of M&A. Early on, in the second quarter and into the third quarter, I think we saw a lot of add-on activity. Financing available for platform companies or existing platforms looking to continue to grow through add-on activity, access to capital. Later in Q3, we've seen a tremendous bounce back. With larger transactions. I think 36 transactions north of $5 billion. So very strategic M&A activity happening, in the back half of the year. Some of that, as Scott, mentioned, very supportive, by SPAC offerings, lots of capital, 250% more raised this year than last year. And so that's been deployed rapidly with very sophisticated investors and very large transactions. I would say, if you've got a COVID, or recession resistant business, the valuations have bounced back not only to pre-COVID levels, but, trading well north, pre-COVID, valuation. So, the market's definitely returned for businesses that have, substantiated themselves through this downturn.
Marshall, thanks. Your question dovetails into my next question, which is when you look out at the beginning of 2021, what do you think the first couple quarters look like? I know a lot of our thinking has been that it's a pause or a timing issue, and that a lot of stuff is going to be pushed out in the first part of next year. Obviously, you've got some potential tax changes out there, but what's your view on first and second quarter of 21?
Yeah, I continue to be really positive about first and second quarter. Again, you've got accommodating, debt markets. I think we've seen just a little bit of ease up, in certain transactions, where people were rushing to get something done by year end, especially with, some of the results of the election. We've seen some of that, but continue to be pretty bullish, on the first and second quarter. $4 trillion of capital deployed, 2.5 of that, involved with private equity, another $1.5 billion, sitting on non-financial, companies' balance sheets, and just, looking for areas to, continue to have that deployed strategically, to drive returns, in a low rate environment. So, I think we continue to be pretty bullish, for Q1 and Q2.
Thanks, Marshall. Lance, what's your view on the first and second quarter of 21?
Well, I come at this from a different perspective than Marshall on the restructuring side, but it seems to me that, so long as we continue to have that restructuring volume, and anytime you're converting debt to equity in these enterprises, you've got a lot of unnatural owners in these businesses, and invariably that leads to M&A activity. Those unnatural owners, whether they're bondholders or banks or other participants in the debt capital markets, are almost always looking to transact, and really the threshold can at times be much lower than original equity expectations. So that certainly underpins the overall health of the M&A market, and as sort of the natural run through the cycle of capitalism. And I think if you look forward 2021, that's going to be a significant driver for M&A activity on the whole.
Agreed. Bruce, what are you seeing in specialty finance, and what's the view as we head into 21?
Brad, look, I think generally the world has so much improved here over the past couple of quarters, and we've got so much more visibility on how these businesses can now perform as COVID has developed. The stimulus package, the unemployment insurance, et cetera, really impacted volume significantly for our clients, but it's starting to come back. And I think as we get more visibility on the health of this consumer and how they're going to behave, we'll see that drive deal activity in 2021. I think more specifically, just kind of two pockets, and I know Scott and Marshall have mentioned the SPAC environment, but I think that's going to be a huge story in 2021 M&A in our industry as well as others. Just a little more specifically, I mean, there's been $60 billion of SPAC capital raised in 2020 and another approximately $20 billion of deals on file. There are 160 SPACs looking for deals right now. And I think particularly in our world in specialty finance, where there's a fintech or an e-com angle with a high growth story with strong profitability, it fits perfectly for SPACs. And then the final thing I'll mention, just on I think the deal environment next year, I mean, there's so much capital on the sidelines across kind of all pools of capital, but I think we're going to continue to see direct investing activity ramp up from the permanent capital guys, right? The family offices, the sovereign wealth funds. And I think we, over the last 36 months, we've seen them get increasingly active in their direct investing and making acquisitions directly. And I think that'll continue into 2021, particularly with more visibility on COVID.
Yeah, completely agree with you. And that's been a big area of focus for us, investment over the past couple of years. So we definitely have that same feeling, Bruce, I think, across all of our groups. There's been quite a bit of discussion, I mean, on the heels of the election about increased taxes as we head into next year. And for those of you guys that are in Georgia, you're kind of the decision point for what ends up happening with the Senate and whether or not those tax increases are muted or we get full strength. But what are the views of an impact? What are the views and impact of higher taxes, not only on our clients' businesses, but also on business transactions, buying or selling other businesses? Bruce, do you have any thoughts on that?
Yeah, look, I'll start, Brad. It's interesting. Look, the environment that we've been in, I mean, certainly the interest rate environment that we've been in, and where we've been on capital gains taxes as well as corporate taxes. I mean, I think it's, it has certainly helped the environment. I think from our standpoint, two things. I think I'm much more concerned about the regulatory posture overall of this new administration going into 2021. Obviously, regulatory risk is near and dear to my heart as a specialty finance investment banker and how it impacts my clients. But I think that's the bigger concern to see, right, how much tightening we're going to get, right, from a regulatory standpoint, and how that will ultimately impact M&A volume, valuations, et cetera. But I think specifically on your question on taxes, and again, knock on wood, hopefully the Republicans will still be in control of the Senate after we go through these two runoffs in Georgia. But look, and I mentioned this a couple of minutes ago, I mean, there is so much capital on the sidelines, whether it's strategics, sponsors, permanent capital, family offices, sovereign wealth, and that capital needs to be deployed. And I think even in the unlikely chance there is a change in overall tax structure, I don't think it's going to slow that train down, because that capital needs to find a home. And it's, people are just going to keep doing deals. Maybe there's an impact on valuations, but I don't think it's going to impact activity significantly.
Marshall, what's your view on impact on valuations as well as activity?
I mean, I tend to agree with Bruce. I mean, it's, an increase in taxes and a substantial increase in taxes at that level. It definitely has an impact, in a vacuum, right? While it can decrease, the net cost of debt or leverage, depending on how deductible, the interest expense is, that certainly can be a question heading into 2021. While it decreases that part of the weighted average cost of capital, it certainly increases the cost of equity, right? There's just less, equity capital, in a given year, to continue to deploy and grow the business at the same rate. So it does have an impact on weighted average cost of capital, which, you would think would have some impact on valuation. But I completely agree with Bruce. I mean, you've got fiscal stimulus, you've got economic recovery, you got the credit markets, and you've got this, this flood of capital that's sitting on the sideline. And so, net, while it's going to have some impact, I don't see it having a tremendous impact on transactions. Having said that, we've certainly seen some clients that have been sitting, on a large capital gain, that have either rushed, to try to get, their transaction done this year, or, they even come back and say, hey, we're going to, we'll hold back, continue to own a great business, a growing business, and figure out what to do from a capital gain perspective, later on. Or as Nick mentioned, we've certainly seen people have an interest in, maybe taking a dividend, pre-end of the year, and continue to hold on to that great business. So, it definitely is having some impact, but overall, I don't see it having, a major impact on deal volume, headed into Q1 or Q2.
Nick, you touched on this a little bit earlier about the velocity of transactions within debt capital markets. I'm looking at the long end of the curve, and we've seen a moderate rise in long rates, treasury rates. As we look out into the beginning of 2021, what are your expectations, not only for the velocity of deals, but what kind of terms are going to be available to borrowers?
Yeah, it's a good question. You make a good point that the treasury rates are ticking up a little bit, which I think will cause people that can be opportunistic to attack the markets now before those spreads start to widen. Now, it's anybody's guess how much wider they go, but they certainly are starting to increase, which, whenever somebody sees those moves and have the ability to hit the markets, they go ahead and do that. So I think for performing companies, there will be a lot more opportunistic financings, whether it's for a dividend or growth capital or otherwise. And I think there's going to be plenty of demand for that from a lender's perspective. And I think, interestingly, what's going to happen, and we've already started seeing it, is companies that did, experience some pain with COVID or are experiencing issues there, lenders are just having to start get more creative and in order to put capital to work. I just had a call with Ares Capital, and they were complaining that they've never lost this number of deals in the last 24 months as they have now, and just feel the credit markets are more competitive than they have been in the last 5 years. And that's an asset manager, one of the largest in the world. that has pockets of capital up and down the credit spectrum at various spreads. So they are losing deals where their strike zone is, just shows you how competitive it is. So as that happens, that allows companies that maybe have a little more hair on them or a little bit more of a story. It allows them to enter the capital markets because there's so much competition. People are willing to really do the work to get to know the business and underwrite that credit. So we've seen record volumes in the institutional market and the high yield market exceeding volumes from 2019. We expect that to continue. And then on the private side, again, I think it's going to be people very aggressively attacking performing credits for opportunistic financings, and then more difficult stories just to put capital to work.
Nick, talk for a minute, if you will, about the increasing fragmentation within the debt lending markets and the role or advantage of having a debt advisor to help navigate that.
Yeah. Look, several years ago, you could just pick up the phone and you could call, a bank that you've had a relationship over a long period of time, and they would give you the capital you need. We're seeing less and less of that as banks tighten up, especially in this environment. We've got a lot of stories where companies are complaining about a 20-year relationship that really tightened the screws on them when COVID hit. And so, providing the services that we're providing, and a lot of the calls we're getting now are calls saying, listen, I've had the same lender for a long time. I'm just not getting the flexibility I need. I'm just not getting the capital I need. I'm ready to grow and my lender's not. And so when we pick up that call, we show that company or companies what capital markets are out there. It's not just banks. You've got institutional investors. We've seen a lot of activity from insurance companies. If you look at the treasury rates, a lot of their capital is invested there. And so they are all raising funds to put into the private markets. And so hiring an advisor such as Stephens allows you to attack all of those markets to get the best possible terms. And best possible terms is not always just rate. It's also, to our conversation earlier, covenants, ability to grow that facility, and the use of proceeds. And so a lot of what we do is, again, educating companies on the debt capital markets that are out there, the pockets of capital to go to, and we go to all those markets at the same time. Whereas a company can't make 30 or 50 phone calls themselves. When we get engaged, they call us, we know the story well, and then can have all 50 or 100 of those conversations for them.
All right, Lance, although restructurings have gained a lot of attention this year, just how active is the beginning part of 2021 shaping up to be?
Yeah, thanks, Brad. I think just piggybacking on what Nick was speaking to a minute ago in terms of the structure of some of this credit that's out in the market, and particularly on the covenant side, many of the issues we've been dealing with in 2020 have been covenant related in nature, and that seems to be the impetus or the driver for getting our team involved. And so taking a step back, if you think about that holistically, as Nick said, it's not just rate, it's what goes along with the bells and whistles of your credit facilities. And you seem all that together, and it does seem likely, just based on what we've seen in 2020, that in 2021 we're going to see an uptick in financial restructurings as the market flushes out. And really, I think it's the second, third, maybe even into the fourth quarter. I think it's probably helpful just statistically to take a step back. And one of the things we track is the distressed high yield bond universe. And early in 2020, that index, in February-ish of 2020, as measured by yields, was showing about 180 billion in distressed high yield volume. By April 1st, that number had shot up to over 900 billion. But today, that number's down below 220 billion, and it's headed downward. So we're almost back to where we were in a pre-COVID environment in terms of measuring distress in the market, and that seems pretty remarkable given everything that's going on. But if you apply that on a go-forward basis, what really happened to cut out that large section of the market? One, a lot of businesses were able to find financing, to Nick's point. But second, we restructured a lot of businesses in 2020. There was a lot of equitization that occurred. So those businesses that couldn't tap the markets for new financings and had defaulted debt were ultimately equitizing those balance sheets. So the in-between, however, was made up by groups that were doing either long-term forbearances or amendments to bridge to a sort of non-COVID economy. And given that we all expect we're going to be working with a low interest, yield-starved environment for some time, that notwithstanding, even though the capital is cheap, you're still going to have companies that borrowed heavily to survive the pandemic that fundamentally have an altered business model. And that leverage problem will come back eventually. It's going to have to get dealt with. And it's, pretty infrequent you see a company grow into its balance sheet. So we think in 2021, particularly in the second half of the year, there's going to be more restructurings to come.
Scott, you touched earlier on the percentage of deals, equity deals that happened this year out of technology and healthcare. What about the other sectors of the market and their need for liquidity? What have you seen there?
Well, obviously, as I said, tech and healthcare have been strong, but so, some other sectors. We've seen consumer growth in terms of issuance, some of that being the rescue trades that we talked about. We've seen subsectors of industrial be very active. Both consumer and industrial are well above their trailing averages in terms of the number of deals and the fee generation in those sectors. So there's been some pretty strong growth across the capital markets this year. But I think the following is true in all sectors. Investors like growth. And so whether that's growth in the healthcare or technology sector or growth in other sectors, companies that are best positioned in their sectors to grow are going to be of the most interest to investors. In terms of what I think will continue to play out across all industries, including healthcare and technology, is when you see a backdrop like we have today, where the big firms aren't using balance sheet the way they once did, we will continue to see issuers in all sectors go to market with companies and their underwriting lineups that know them best. To be able to help those issuers tell those stories to the investors in the marketplace to drive successful outcomes. I think you're going to see more of the same of that in 21. Again, I think companies that are best positioned to grow are going to be the most interesting to institutional investors, but issuers aren't going to take the chance of not having the right team behind them when it's time to come to market.
Thanks, Scott. Maybe we can turn our attention to some of the industry groups we have on the call today and talk a little bit about the trends that stood out during 2020 and expectations for 2021. Phyllis, what are your thoughts around media?
In media, really the only subsectors that were unscathed by the pandemic were content, music content, video content. If you think Netflix or streaming music or podcasts, those have all been extremely strong. Other than that, everybody felt some pain. Obviously, all the live events, Lance mentioned mass entertainment events. So everything from movie theaters to concerts to festivals to theme parks shut down completely, and a lot of them are still shut down. Advertising, interestingly enough, was curtailed for a variety of reasons. Either the brand was shut down completely, or maybe they couldn't get inventory. So why advertise if you have no inventory on the shelves? And maybe the most interesting reason is, and we saw this in the aftermath of 9/11, some brands just feel like it's inappropriate to advertise during a national crisis, like drive a Toyota, and people are locked inside their houses. So we had to sort of work our way through that. And actually a lot of people are anticipating a V-shaped advertising recovery. And we're sort of starting to see a little bit of that already. We anticipated that lenders would be very tough on these companies, that the private equity firms might be a little reluctant to put a lot of new money in with no end in sight. I mean, they know how to deal with the recession. Media is a cyclical business, but they've never been through anything like this where they really don't know where the end will be. And we really thought that they would be very open to opportunistic third-party capital. And what wound up happening was the lenders were much more supportive than we'd expected. It was very situational in media, and they seemed to understand that. And as Lance said, there were not very good alternatives to continuing to work with the company. The PE firms did put money in to support the restructurings and also to support ongoing operations. And the owners of these businesses were extremely reluctant to take any third-party capital. So there was a very significant calendar of sell sides in media, and for some reason, especially in events, before the pandemic. And so what we feel is that any return for even a quarter to any sort of normalcy will result in a lot of people basically saying, okay, there we go, let's annualize that. We're right back to where we were before the pandemic. So we do in 2021 think there could be, assuming that we do sort of start to get back to a more normal situation because of a vaccine or whatever else, that there will be a lot of M&A activity. If the pandemic persists, then it could go the other way. And I think at some point, after a year of hanging in and continuing to support these businesses, some of whom lost 90% of their revenue this year, I think that maybe the private equity firms will be more open to taking third-party capital. So whether it's capital raising or whether it's outright M&A, we do think 2021 is likely to be a more robust year than this was.
Thanks, Phyllis. Scott, within community banking, what have been the key sector level trends this year and expectations for 21?
Well, I'd say it's pretty interesting. You look at the sector today, and I'd say look at the sector yesterday, because today the sector's up meaningfully with this vaccine news, but effectively more than half of the industry had been trading below tangible book value. And this has been an ongoing issue that we've been dealing with really since the fourth quarter of 2018. The valuations for the sector have been really depressed. I think driving that is really the concern around credit growth and margin. And at least in terms of margin, that doesn't seem like that's going to go away in the short term. But perhaps around the credit front, there's a little more sense of safety that's developing now as banks have higher levels of capital and have really had months to work through this pandemic. But what we haven't seen in 20, which I think we will begin to see quite a bit more of in 21, is M&A. M&A, for obvious reasons, is very difficult in the environment that we've been in. But as I look towards 21, I do think M&A has the potential to come roaring back. The last 8 years, M&A has largely been driven by the need for scale, the need to offset some of the regulatory costs associated with running a bank today. I think as you look into 21, the needs for M&A are going to change a little bit. M&A is going to be needed, I think, in part to help fund a big technology spend that's going to need to occur across the community bank sector as consumer and customer and business behavior will change. And so I think M&A certainly will pick up as people respond to a post-COVID world. Also the fact that for banks, the need to get more efficient, to really rationalize their branch networks, their whole go-to-market strategy is something that I think M&A will look to address. And so the biggest trend to the uptick will certainly be M&A in my mind.
Bruce, within specialty finance, what have been the key trends this year, and what do you see going into 20?
Yeah, Brad, it's a good question, and some of this has been touched on before, but I think in general, the amount of deal activity within the debt capital markets arena has been extraordinary for our team this year, and we've got a super full pipeline going into next year. Nick Bellman touched on this a little bit ago, but the specialty finance arena, which we consider kind of non-bank lending in general, obviously it's a big space, but such an attractive arena for risk-adjusted yields for those investors that are chasing yield. And so across institutions, right, across banks, different pools of capital, they've all been super busy looking for deals in specialty finance. So generally, that's the first answer to the question. But getting more specifically within specialty finance, and this has really, I think, been driven by pain that we've seen in the retailing sector and the shift and change in consumer purchasing activity. But the whole retail point of sale finance space, where a lender is enabling a consumer to acquire the good or service that they're looking to acquire, generally at the point of sale, whether that's in a retail location or that's online. That entire arena has blown up, really up and down the credit spectrum, from prime all the way down to deep subprime. We've seen an enormous amount of deal activity within debt capital markets, We've seen a number of companies that have gone on file to go public or planning to go on file to go public. We've seen M&A activity pick up. We just closed a deal at the end of last week in the space, and we think that's going to continue in 2021 in a really strong way. It actually started pre-COVID. The whole retail point of sale finance space has probably been one of our busiest sectors over the last 2 to 3 years, and it's just continued to pick up momentum through COVID, and I certainly think it's going to continue.
Brad, within specialty distribution, same question to you. What are the trends we're seeing during 20, particularly right now, and looking out into 2021?
I mean, I guess to borrow from Lance's phrase, it's a tale of have and have nots here. Generally, the industrial market within specialty distribution has been very slow to come back. We entered into a downturn in Q4 of last year. Certainly COVID exacerbated that slowdown. General industrial trends have been very slow to return. We're starting to see some positive numbers out there, but certainly not enough to point to a trend yet. A lot of industrial credits are off 10 to 25+% on the top line. So they've been highly inwardly focused on taking permanent costs out, or certainly taking costs out and trying to right size their business as quickly as possible. I think when we start to see a resurgence in activity and the economy starts to bounce in more of the general economic sector, these names are going to be performing extraordinarily well, much more efficiently. They're going to be doing a lot more with a lot less. They're going to be managing working capital a lot more aggressively. So we're optimistic there. But we need to see some clear direction in the market. We need to see some definition around more of the heavy industrial part of the market. It's very difficult for people to even give a prognosis on where their business is going right now. So many conversations we've had with CEOs, they can't even forecast their business over the next 2 quarters, much less the next 6 quarters. So until we can get some definition around the economy, it's going to be very difficult to see a resurgence in demand there. It's not to say that there aren't pockets in the specialty distribution world that are doing quite well. I mean, we've seen building products as a real bright spot. Statistics point to a shortfall of 8 million single family homes out there, a lot of remodeling activity. So building product names have done quite well. We've seen a resurgence in focus on infrastructure plays, things like waterworks, highways, et cetera. So that's an area we see a lot of activity for. We know we came into this year believing it was going to be an incredibly active year, but as things started to slow coming into COVID, our conversations, especially on the private equity side, where these guys are managing very large portfolios of names, they were postponing indefinitely, 80-90% of sale mandates indefinitely. So we do expect those to see a resurgence of opportunities coming into 2021. But we still need some definition and certainty around the marketplace.
Maybe we can turn to consumer for the next couple of questions. Christopher, within consumer, it's been a year of haves and year of have-nots. I mean, there's been very mixed results with the businesses. Maybe you could touch on a little bit. How do you see most of the consumer businesses positioned today, and from an investment banking perspective, how do you think folks are thinking about opportunities as we head into 2021?
Consumer sectors definitely experienced a wide range of outcomes this year due to COVID. And within the food sector, where I obviously spend much of my time, one of the clearest dichotomies has been between companies focused on the retail channel, where generally demand has been strong, and companies focused on the food service channel, where demand has been significantly weaker. So it's a story of haves and have-nots. But for the food retail focused players, we've seen significant continued deal activity. And as examples, Cal-Maine, which is the largest producer of shell eggs in the US, and Mission Produce, a very large integrated producer and marketer of Calabos, or of avocados in the US. Both completed successful equity offerings in the past few months. We were fortunate to play a role in both of those deals. We're also seeing continued deal activity in the private placement market for retail-focused food processors, and particularly from a minority equity raise standpoint, where both private equity and family offices are showing significant interest. On the other hand, for food service-focused companies that in general have faced significant headwinds, this year has really been more about strengthening their businesses and bolstering balance sheets. So we just recently closed a significant financing for a large coffee roaster and distributor that was selling in or is selling into food service. There was strong lender and equity investor demand for this deal, and these types of financings are crucial in helping those companies manage through COVID and beyond. So yes, quite a mixed bag across the industry landscape.
When you think about activity businesses, I mean, you've seen a surge this year with COVID, people staying at home, physical fitness, et cetera, in a little bit different scale. But when you think about social distancing, when you think about the consumer changes in consumer behavior, you know, what are the innovative channels that are emerging here? What's new? What are the consumer markets really paying attention to right now?
Well, consumers have definitely turned to health and wellness as they spent more time at home and outdoors with their families, with their close friends, engaged in recreation and leisure. There are 4 key areas that we think about when we think about this trend that parallels different product categories that we follow. So one is at home. So activities, solo endeavors like stationary bikes and home workouts. Then you have home adjacent, such as outdoor cooking, barbecuing, do-it-yourself home projects. Then the third bucket that we focus on, close to home. So trusted kind of bubble activities like running, jogging, golf, and tennis. And then lastly, further afield activities such as fishing, hunting, and camping. And these areas have not only seen a resurgence from historical enthusiasts, but also, of course, from a lot of consumers who are wanting to spend time in these activities given the environment. And so as a result, sporting and leisure food companies or leisure goods companies, both the brands and the retailers have really performed extremely well, reporting record year-over-year sales and expanded gross margins. And one thing that I'd point out is that the brands and retailers that have direct-to-consumer capabilities, and in the case of retailers, curbside pickup capabilities, those are the businesses that are performing the strongest. You know, we do think that these trends in the active lifestyle, sports and leisure space will continue through the duration of the pandemic, and will also lead to longer-term increases in demand for these consumer segments. In terms of what companies are doing as they move forward, both the brands and retailers are investing to position themselves favorably to gain market share and compete. And in particular, they're focused on developing or further developing a few key areas of their business. One would be e-commerce platforms that have outperformed the broader markets, both within consumer products and within the food environment. Also, direct customer engagement capabilities and opportunities, or an ability to directly engage, whether that's just to build the brand, but also to sell their products directly to their customers. And then lastly, new product innovation, as well as diversifying their supply chains to diversify the products that they can offer and to produce them more efficiently. So those are some of the key themes that we're seeing in the market.
Phyllis, maybe I'll ask you the same question, but through a media banker's lens.
Right. So where that sort of overlaps media activity businesses, sports and leisure, is again really sporting events, concerts, music festivals, theme parks, et cetera. And it's really been fascinating what these guys have done to sort of find a new model in the absence of the traditional ability of people to gather and engage in sort of experience activities. The two big trends are either virtual events or drive-in a return to the old drive-in. Trey Anastasio, the lead singer and guitarist for Fish, streams live from the Beacon Theater in New York City. Musical artists and comics are doing these enormous shows, drive-in shows, in either fields or parking lots of malls. Nate Bargatze, a really funny comic, just did a drive-in comedy show that sold out 2 fields of 750 cars for 2 performances in Fort Worth last weekend, and they had a waiting line. And then there's a live entertainment company that's a client of ours. So if you think of something like Disney on Ice, a family branded touring company, pivoted from a model that was 3,500 people through the event a day to doing pop-up drive-in theaters and mall parking lots all over the country, and almost made their numbers doing that. And similar to what Christopher said, another thing that we don't think drive-ins are going to be a surviving trend. So enjoy them while you can. I think that there may be more indoor-outdoor venues going forward, but I do think there also will be a lot of technology innovation around touchless or minimal touch access in venues, sports venues, entertainment venues. So if you think about, or, to buy concessions, to buy merchandise, ID verification to buy alcohol. If you think about a company like Clear that you see in the airport, they're also deployed for admissions at some sports arenas. And I think there'll be more things like that. They use a retinal scan, so it's faster and obviously safer. And then there's a company called Appetize that is a mobile point of sale company that basically gives you a bracelet, and you can walk around the arena and use the bracelet without touching anything or anybody to buy concessions or buy merchandise. So we think those kinds of companies are here to stay, and that they have a huge pipeline of potential customers out of this. Their business has been tough in the meantime, but they do have huge pipelines of people, interested in deploying them that don't already have the capability. And finally, we think families will flock back to family entertainment as soon as they can be comfortable with safety. I mean, everybody's been locked up for months, homeschooling at least part of that time, quarantining. So we think as soon as these family-oriented mass entertainment venues can safely be reopened, there's a lot of pent-up demand there. And I think that's really the main place that the activity businesses overlap with media.
Bruce, your business obviously is touched by consumers, given its focus. For the businesses that are performing well and the businesses that aren't, how does that change their investment banking needs as they look forward?
So it's interesting, Brad. I mean, look, and we've seen a wide range of outcomes as COVID has developed, as 2020 has developed. I mentioned earlier about a number of our clients were really struggling for loan demand. And obviously we cover a lot of consumer lenders, right? But with stimulus, unemployment insurance, et cetera, right? And people weren't out spending money. There was just not a need for credit, right? And we're still seeing it from some of our clients right now that they're really struggling to generate demand. Now, as you move to other parts of the credit spectrum where maybe that consumer is out spending money again, right? We've seen demand come back, particularly like in the storefront installment lending sector, the OneMains of the world, the Lendmarks of the world. Their volume has come back super strong. So to answer your question, as you think about it, right, for some of the companies that are still experiencing pain, there's certainly been some balance sheet pain, right? From a liquidity standpoint and a need to clean up the balance sheet. Maybe they have a bank lender who has decided to step away from a certain sector of consumer finance. The good news is for those negative situations like that, right, we're in a super liquid credit market environment. And so while we may not be able to go to the bank market to solve their balance sheet issues, we may go to the institutional credit market. And we've got a number of those situations right now that we've been working through. Now, if you switch to the other side of this, where our clients have got good visibility on the evolution of COVID, their loan demand has come back, their credit performance is still strong. Those companies, right, we think are in a great position to play offense. And whether that's from an M&A standpoint, thinking about consolidation in their sector, or maybe from a product diversification standpoint, going to get right a new skill set or a new product to add to their bailiwick. And just quite frankly, from a liquidity standpoint, earlier in the year, we certainly couldn't have fathomed the ability for a lot of our clients to be able to tap certain markets to go get liquidity for shareholders. And that's changed dramatically for a lot of our clients. And we have folks right now that are getting teed up to explore sell processes or minority equity recaps as we get into 2021, given the visibility that they have in their business and the overall market. So I'd say those are the key themes, Brad, and it's a wide range, right? We've still got clients in specialty finance that are feeling the pain of all this. And then the flip side, we've got some clients that are super healthy and sit in a very attractive spot.
Brad, we built one of the premier specialty distribution practices out there. And, what's been interesting is we've continued to see a fairly high level of activity throughout this process. What's driving that?
I think there's a couple of things, Brad. One, it's a move towards efficiency. It's a move towards understanding your customer set better and how do you provide solution selling and solution products to that group. There's a big move on e-commerce to be competitive here, especially trying to figure out how do we, if we're more in the C-class parts world, how do we compete against the Amazons and the Grangers of the world, two big behemoths that have very, very efficient platforms, very efficient logistics businesses. The other is a movement towards more engineered products. And by that, I mean things like pumps, things like flow control systems, fluid conveyance, fluid power. These are businesses that are assembling, designing, engineering complex systems for their clients, for their customer sets, and driving a lot of value. And a lot of these businesses have also built service businesses around their product sets where they've got engineers and design folks crawling around their customers' production lines, looking for ways to do things better, looking for ways to deploy automation, looking for ways to deploy robotics. So I think those are areas that we have had a lot of focus on as opposed to kind of the pick, pack, and ship model. But delivering a real value and something that you can layer in a long-term service offering around, so you kind of capture a more ratable revenue stream, if you will.
Maybe just one more question on 2020. When we look back at 2020 and we look at our clients and we think about the goals they're trying to pursue, obviously there have been quite a few obstacles. Just looking for a quick response here. Lance, what would you say are the biggest obstacles your clients are facing?
Well, I think, broadly, if you think about the forms of currency that people have in the market, whether it's relationships or, the quantum of time or money, whenever you're in the middle of a crisis, often you're short on one or more or all three of those things. So helping clients determine how to, leverage their currency, whatever it is, whether it's the relationships they build, the underlying business, or the capital they have access to, figuring out how to help them leverage that to the desired outcome, I think is the name of the game. But that's been the challenge for sure in 2020 in such an uncertain market.
Christopher, same question for you.
Yeah, I'd say two big challenges that I'm hearing from clients. The first would be employee and labor challenges. So just the challenges in a manufacturing or food processing environment or retail of keeping your employees safe, getting them to report to work to the extent that there have been infections, finding and hiring qualified employees, particularly in the manufacturing arena, and of course, the related incremental costs of some of these challenges. And so we're hearing this feedback across our client base. And I think we're hearing that, across the economy as well. The other thing I would say is just the challenge of managing your legacy business in a much more complicated strategic operating and financial landscape. And so I think those companies that got out in front of their business, they saw what was coming in terms of either positive trends or negative trends, and developing strategic operating financial action plans to help them focus and manage their organizations, and hopefully ultimately help them succeed in a very different micro or macro environment.
Phyllis, same question for you.
Piggybacking a little bit on what Christopher just said, I think we had a moment of denial in media where a lot of people just stopped and took a breath and really didn't believe it was going to be this bad or that it was going to last this long. And very quickly following on that, as I mentioned before, adaptation, in some cases, complete adaptation of their business model to work in sort of the new normal. And then finally, and something we really haven't talked about, is assisting brands to align themselves on some of the social issues that have emerged this year. Whether it's diversity or small business support or social distancing and wearing masks, that's not something ad agencies and media operators have had to really worry about. And now it's a huge priority for some of their clients. So that's been another challenge that I don't think anybody anticipated.
Last question, when we think about, and Nick, you touched on this a little bit, and Marshall, you did as well, but when we think about where interest rates are today, what commentary we've seen out of the Federal Reserve, maybe I'll start with you, Marshall. How will deal activity be impacted by U.S. monetary policy?
Yeah, Brad, I think with a very accommodated Fed and just where interest rates are, I think it's a couple things. One, it contributes to the tremendous amount of liquidity which we've talked about into the market, and at the rates, and the expected returns have come down, which makes projects, M&A activities, investments more palatable, at lower expected, rates of return. And so, again, it's a very, accommodating Fed, and it's very accommodating, to the investment or the M&A market. And so I continue to expect it to, be very supportive of the M&A market. Again, the capital that needs to be, deployed, where, private equity firms, public companies, are graded on, allocating capital, and they've just got a tremendous amount of it to put to work. And so again, I feel like it's very supportive, of a very, strong M&A market heading into 2021.
Thanks, Marshall. Nick, any thoughts around that?
No, just the theme I had mentioned before. I think all asset managers, whether it's banks or institutions, are trying to find a way to earn a yield on their assets, and they know they can't go to treasuries to do that. And so I think we're going to see lenders continue to be aggressive, start thinking outside the box, and trying to find places to deploy capital. And as long as the treasury rates are down, even risk spreads can be elevated, and the net spread still makes sense for borrowers. So, a lot of the same themes I touched on before are driving this, and will continue to drive this, including opportunistic financings for companies that may not need the capital, but given where spreads are and treasury rates are compelled to do something.
I just want to take a few seconds and thank everybody for participating today. It's been an excellent discussion. It's been thought-provoking, insightful. Obviously, 2020 has been a very challenging year, but as we head into 2021, there's still a lot of questions that are out there. I think there's some areas where we've got strong tailwinds and some areas where people are going to face continued headwinds. And as you do that and as you think about it, we pride ourselves on being in a position to help you think through those things. And, we've always thought about businesses as if we owned the whole business ourselves, and would love to have an opportunity to talk with you about it. We look forward to seeing you at our conference, and thank you for your time.